Hi, I am Kelsey Johnson, and this is my Finance 653 Industries Financial Analysis project. My first industry was aerospace and defense, my second industry was supermarkets, and my third industry was tobacco and tobacco products. In the aerospace and defense industry, we have Boeing, Airbus, Arconic, Lockheed Martin, and United Technologies. And these are some little information summaries about the companies in the industry. First, we have Boeing. They have three business units, which consist of commercial airplanes, defense, space, and security, and their Boeing Global Services. So they basically deal with, the airplanes that you ride in regularly, and then space, different things, exploration, and then military objects. And then we have Airbus, and they manufacture airplanes and military equipment also. And they also have three business units: Airbus, Airbus Defense and Space, and Airbus Helicopters. Next, we have Arconic, which produces and distributes aerospace products. They offer engineered products and solutions for the aerospace, industrial, gas turbines, commercial transportation, and the oil and gas markets. Then we have Lockheed Martin, which is located kind of local. They have one, I know, in Bay St. Louis in Mississippi. They're a global security company that primarily researches, designs, develops, manufactures, and integrates advanced technology products and services. Their company businesses span space, telecommunications, electronics, information and services, aeronautics, energy, and systems integration. And the last company in the industry is United Technologies. They have a couple segments. Also, they have Otis, which is their elevator and escalator manufacturing company. Climate and Security, which is alarms, monitoring equipment, goes in homes. And then they have Pratt and Whitney, which is where they do commercial and military engines. And then they have Aerospace Systems. And this is their different supply chains. Boeing has 330 suppliers with 63 customers. Airbus has 296 suppliers and 97 customers. Arconic has 16 suppliers and 57 customers. Lockheed has 173 suppliers and 22 customers. United Technologies has 186 suppliers and 113 customers. And a lot of these companies, they share some of the same suppliers and a lot of the same customers as well. So people kind of buy, people who are in this industry are buying from all of these different companies, and a lot of the same suppliers are having to have the same customers, and they're all making different things, but they must be made the same way because a lot of them have similar suppliers and customers. So first, we evaluated the aerospace and defense industry short-term solvency ratios. The current, the green is the averages for the whole industry. We found that in years 1 through 3, Boeing and United Technologies fall above the industry, while most of the others fall below the industry average. And Arconic has no information given on their current ratio for the first 2 years, but in year 3, Boeing and Arconic are way above the industry averages, and United Technologies drops below. In year 4, all companies except for Arconic fall below the industry average when looking at the current ratio. In year 5, all companies except Boeing start raising their current average, but Arconic continues to increase their current ratio across all of the years that they are in business, and they're way above all of the other companies. For the quick ratio, because of the type of industry that they're in, which is obviously high inventory and expensive inventory at that, their quick ratio is expected to be low because their inventory plays such a big role with the kind of industry that they are in. And Boeing and Airbus stay below the industry averages for the past 5 years, while United Technologies and Lockheed remain above the industry averages for the quick ratio. No information is given on Arconic for the first 2 years, but in year 3, Arconic, United Technologies, and Lockheed Martin all have increasing quick ratios way above the average. So they are improving their ability to meet short-term obligations as they are moving. And then the cash ratio, which measures, how liquid, the real liquidity of a company. In year one, Lockheed Martin, United Technologies, and Airbus fall below industry averages for the cash ratio, while Boeing is the only company above industry averages. In year two, Boeing and Airbus are above industry average, but Boeing is declining, and they continue to decline as you look over from year one to year five. And then in years 3 to 5, United Technologies and Arconic are the only companies falling above industry averages, with everyone else staying pretty consistent, but remaining below. And overall, it looks like Arconic, when they actually come into the industry, they really go above the rest at as far as their liquidity goes. A lot of the others might struggle with paying their short-term obligations, but it doesn't seem like Arconic would at that point in time. And next we look at the aerospace and defense industry's long-term solvency ratios. First we look at their equity multiplier, and you can see that for years 1 to 4, most of the companies, they all stayed pretty average, a few being above the rest. And you can see Boeing is increasing their leverage over the 5 years, but in year 4, they start increasing their leverage use quite a lot. And also so do Lockheed Martin. And Arconic has no information on leverage, but they start using leverage, but way below average, down there with United Technologies. And then when you go over to the times interest earned ratio, you can see Boeing and Lockheed are way above averages with meeting obligations. They start pretty high and then they kind of go down, but as soon as they, they're always able to meet their obligations for their interest and for paying off their debt. And you can see whenever they go and from year 4 to 5, when they increase their leverage, they are more than capable of making their debt payments. Arconic's kind of down there. They are struggling with actually being able to pay off their debt obligations, so it's a good thing that they're not taking on anymore. All companies are able to pay off their debt obligations, but it's definitely Boeing. Boeing is most able to, and seems like they're using their equity, their leverage to their advantage. Next, we look at the asset efficiency in the aerospace and defense industry. Overall, the industry averages are pretty low. They only really range from 0 to a little bit over 1, but it's definitely something having to do with their industry. I'm sure the things that they're selling are huge, expensive. The companies that are purchasing them, they don't purchase many in a year, so that definitely has something to do with their asset efficiency, the industry asset efficiency being pretty low. So overall, industry averages are low, like I said, probably due to the kind of industry that they're in. Lockheed Martin definitely has the highest asset turnover in the beginning, but they do start to drop off and then kind of increase at the end. Consistent, but not too consistent. Boeing has the next highest asset turnover, and they're steadily increasing from overall years and kind of cap off and remain consistent, but they're increasing, not decreasing. United and Airbus are consistent, but lower than, pretty low they're below average, but they are staying consistent, and that's always a good thing. And Arconic doesn't have any information given from years 1 to 2, but then as you can see, when you hit year 2 and you go up to year 5, they're steadily increasing, and making huge increases, which seems like, if we'll see this year, but whenever they go to year 6 and year 7, if they keep going at this rate, they're gonna eventually end up passing Boeing and Lockheed as far as being the most efficient with their assets. So I would say between Arconic and Boeing, they have the best asset efficiency. Um, Boeing's asset efficiency increases uh, and has a high asset turnover for the whole time. Lockheed's just not as consistent and actually decreasing for majority of the years. So I would say that Boeing probably has the most efficient, and I would say they're the most efficient and consistent as far as asset efficiency goes. Next, we move on to profitability ratios. Looking at the profit margin, Boeing has small fluctuations, but for the most part, they are growing, especially from years 4 to 5, which, as we saw earlier, was also the years that they were increasing their leverage. So it seems like they're using their leverage to become more profitable, make more sales, and improve their overall company. Airbus is not very consistent and has profit margins below the industry average. Arconic has many fluctuations and negative profit margins from years 3 to 5, so they're not keeping any of the money that they're making from sales. This could be because they're a new company, but when compared to the other ones, you want a company that's profitable. So we'll see what their future is like. But as far as in the past 5 years, they have been operating on negative profit margins. And Lockheed Martin has growing profit margins, but they drop in year 4. And 4 out of 5 companies have significant decreases in their profit margins beginning in year 3 and lasting to year 5. Seeing that this is happening in majority of the companies in the industry, it must have to do with a common operating issue across all companies. But as you can see, at a time where almost all companies are operating at low profit margins or falling profit margins, Boeing is one of the companies with a higher profit margin that actually are doing something right and making their profits go up from year 4 to 5 when most are going down. And when you look at return on assets, profit margin and ROA are pretty similar for the companies as far as which companies are fluctuating and which years they're fluctuating. Boeing is definitely the most consistent, and their ROA is increasing as most other companies' ROAs are decreasing. In addition, they are consistent prior to their large increase from year 4 to 5. Something is happening within the industry between years 3 to 5, causing the company's productivity to go down. But the only company who doesn't ever significantly decrease its productivity over the 5 years is Boeing. Next, we move to the ROE, and we have the ROE broken down into tax burden, interest burden, EBIT margin, total asset turnover, and the equity multiplier, to try to see what is driving these numbers. And as we've talked about previously, you want EBIT margin, total asset turnover. You want those to be mostly driving your numbers. And if you're using leverage, that's fine, but you want them to be able to afford their debt, which we looked at earlier. So Lockheed Martin's ROE is definitely driven by leverage. And then Boeing has the second highest ROE, and Lockheed has overall the highest return on equity. But like I said, they are driven by leverage, which is not something that you necessarily want them to be driven by. They do have a higher EBIT margin, but they fluctuate with their use of leverage. And Boeing has the second highest ROE. They have a tax burden consistent with the industry, a high interest burden, but it doesn't fluctuate where their ROE fluctuates. They have a middle EBIT margin, but overall, we think Boeing's return on equity is driven by assets and EBIT margin. In the years that Boeing's return on equity is increasing, so is their EBIT margin and their leverage. And then United Technologies, their numbers are driven by their EBIT margin. They're efficient with their operating expenses, but they are low on asset efficiency and operate below average on most of the other ratios as well. And looking at ROE, I think that Boeing was the best option because they do have a good EBIT margin, and that is also something that is driving their their ROE, uh, but because it was kind of thrown up between Lockheed and Boeing as far as whose is the ROE is the best. But because Lockheed is mostly just driven by leverage, even though both leverage is playing a big part in what is driving those numbers, I feel like Boeing having a good EBIT margin and that being a part of it, they probably, looking at ROE, are the best one for this profitability ratio. Next, we move to the market value ratios of the aerospace and defense industry. When looking at the price and earnings ratio, Boeing has a declining price and earnings ratio until year 5. Airbus is just extremely inconsistent, and when making an investment, probably not who you would go with. Arconic is consistent and close to average for the industry, so the market is thinking of them as being around for the future. Lockheed is steadily increasing all 5 years, so the market just really keeps thinking highly of Lockheed, and I guess continues to live up to their expectations, seeing as their price to earnings ratio never drops, neither does their market to book ratio, which is good for them. United Technologies remains consistent with few small fluctuations, and it seems like the market thinks Boeing and Lockheed have the most promising futures relative to their past, although, as you can see, all are fluctuating up and down when you look at the price to earnings ratio. For the market to book ratio, Boeing, the market really likes Boeing in years 4 to 5, way more than every other company's market to book ratio. So investors may think it is overrated, but the market is seeing that they're doing good things and have a promising future. Airbus remains low across all 5 years. Arconic is low, but they are a new company, so so that could be one reason why. Lockheed, as the years goes on, the more the market thinks they have a promising future. And United, the market thinks the same of them across all 5 years, which they're pretty high on enterprise value and everything, but they're pretty low on market to book and yeah. So as far as economic value added goes, all companies have major fluctuations over 5 years. All get below zero at some point over the past 5 years. The company was generating no value with the funds that were invested to them, and that goes for almost all the ones in the industry at some point. And it probably has something to do with the industry that they're in, seeing as EVA is just all over the place for every single one. And then when you look at enterprise value, Boeing and United have values way above the industry average for all 5 years. Lockheed operates below average, but then becomes one of those above averages for years 3 to 5. Overall, Boeing and Lockheed are expected to show the most growth in the upcoming years, according to the marketplace. Boeing may be overvalued, but the market sees them as the most promising for the future. So making an investment, people who you think that they're overvalued, they might not want to pay for the price of Boeing, but I think it's a compliment to Boeing as a company that people in the market are willing to pay so much for their company. So now we're going to look at the cash flows for the different companies in the aerospace and defense industry. Boeing has the most free cash flows, with Lockheed and United fluctuating around the industry average. Lockheed is steadily increasing, while United Technologies is decreasing from years 2 to 4, but they do begin to increase again in year 4. Overall, Boeing has the most free cash flows after their expenses and expansions over all 5 years. And that brings us to who we would choose if we could only invest in one in the aerospace and defense industry. And when looking at all the ratios, I definitely think Boeing is the best option. They were not the best for meeting short-term obligations, but they made up for themselves in areas of using leverage to its advantage, keeping operating expenses down, being profitable now, and it was forecast to be profitable in the future. They use financial leverage to its advantage. It is using leverage and is able to meet all of its debt obligations. And as Boeing begins to use leverage more, their profits begin to increase as well. They're using it and being profitable from the additions they are creating with their leverage. And also, during a time where profitability was steadily decreasing for most companies in this industry, Boeing was able to maintain their profits and eventually increase their profitability. They were able to keep their operating expenses down when other companies in the industry were not. Also, although Boeing is not portraying the most efficient asset efficiency in the industry, they are maintaining an above average asset efficiency. When taking into consideration Boeing is doing well with keeping their operating expenses down and maintaining a high asset efficiency, it still makes them a solid choice for the best company in the aerospace and defense industry. Although leverage is helping them to drive their profitability, they are doing well with asset efficiency and operating margin as well. Because of their high market value ratios, it shows that the market is seeing a promising future for Boeing. Although they may be overpriced to investors, like we said earlier, the market is feeling strongly about them, and it's a good sign that a company is doing well. Considering we get all customers, suppliers, and employees from the marketplace, I think having good market value ratios is important when choosing a company that you would like to invest in over others. And that is why we would choose Boeing. So now we are entering into the supermarket industry, and I chose the 5 companies of Ingles Markets, Inc., Natural Grocers by Vitamin Cottage, Inc., Sprouts Farmers Market, Inc., Super Value, Inc., and Weiss Markets, Inc. And first we have Ingles. They have 200 supermarkets across southeastern United States, operating under the name Ingles or Save More. They are located primarily in suburbs, small towns, and rural areas. Weiss Markets, they are a conventional supermarket chain operating through a single segment grocery retail, and they run over more than 200 grocery stores. Natural Grocers is catering to the increasing market of wellness and nutrition. They have 140 stores in 20 states. They sell natural and organic foods. 2/3 of their revenue comes from groceries, while 20% from dietary supplements, remainder from miscellaneous products sold. Sprouts Farmers Market is a fast-growing natural foods retailer. They sell organic and local produce, baked goods, all natural meats and seafoods, imported cheese, bulk foods, vitamins, and supplements. They are the number 2 spot in natural organic retail market behind Whole Foods, and they have over 450 bins of bulk rice, spices, nuts, and grains in their stores. Super Value offers wholesale grocery distribution and logistics services to independent retailers and military commissaries in the U.S. and overseas. They also offer retail operations at over 200 grocery stores under various names. More than 60% of revenues come from the wholesale business, which involves distribution and logistics operation, and more than 30% of their revenues comes from regional grocery stores. These people in the supermarket industry, some of them, they all only use suppliers. Their customers are people like us. Ingles has 18 suppliers, Weiss has 46, Natural Grocers has 1, Sprouts Farmers Markets has 7, and Super Value has 65. Now we look at these companies' short-term solvency ratios. First, we look at the current ratio, and Weiss is consistently high across all short-term solvency ratios, meaning they have the highest liquidity and are most able to meet their short-term obligations. Ingles' current ratio is above average and steadily increasing from years 2 to 5. Super Value Inc. is buying most of their current assets on with receivables. Their ratio is below 1 or close to 1 across all 5 years. Sprouts Farmers' current ratio increases significantly from years 1 to 2, but decreases a little, then goes back up over years 2 to 5. Natural Grocers' short-term solvency ratios are decreasing from years 1 to 3, but then all begin to increase from years 3 to 5. Weiss and Sprouts are most liquid and would be most able to meet their obligations if something went south in the industry, according to these ratios. And according to the cash ratio, Weiss and Sprouts are the most liquid companies in the industry. The rest of the companies are not very liquid and have really close to almost no cash. Some of them have really close to almost no cash in their companies at all. Next, we view the long-term solvency ratios. And looking at the equity multiplier and times interest earn ratio, Ingles has the most debt for the industry, but they are able to meet their obligations. Natural Grocers has debt and has a high T times interest earn ratio, meaning they are able to meet their debt obligations. Sprouts has little debt and it is increasing over the 5 years, and their ability to meet their debt obligations is increasing over their 5 years. So it does look like they're using leverage, but they're using it to their advantage, seeing as their times interest earn ratio is just continues to go up as they become more well known in the market because they are a new company. SuperValue has no leverage information given. Weiss has debt below the industry average, but is also unable to meet their debt obligations, so it's a good thing that they're not using debt. Looking at the asset efficiency in the supermarket industry, Ingles has a consistent asset efficiency but staying below the industry average. National Grocers remains above the industry average for asset efficiency but declines and just continues to decline from years 3 to 5. But they are still remaining above the industry average even though they are declining, and they stay above the industry average for all 5 years. Sprouts Farmers Market is below the industry average, but they continue to become more and more efficient from years 2 to 5. There's no information given for year 1, but whenever they come into play in year 2, they are just steadily increasing, almost at industry average for year 5, and they definitely pass up Weiss and Ingles from years 4 to 5 also. SuperValue continues to improve their asset efficiency, working its way from below the industry average to the highest in the industry by year 5. Weiss Markets remains pretty consistent, but below the industry average for most of the past 5 years. Next, we view the profitability ratios across the industry. Ingles' profit margin is consistent while their ROA is increasing. Natural Grocers has a decreasing profit margin from year 3 to 5, which is consistent with their ROA as well. Sprouts is growing, especially with their ROA. Their profit margin is growing also, but their ROA is increasing pretty significantly. And SuperValue is increasing slowly upon further research because SuperValues, as you'll see coming up, their ratios are all over the place. They are selling off stores, so they were extremely unprofitable. But because as you can see, they're negative 8.55 profit margin, and then it goes up to almost 5. But that is because they're selling off stores and inventory so that they can make more profit, and we'll see whether or not they stay in the industry. Weiss is consistent and stays around the industry averages for both of these profitability ratios. Next, we evaluate ROE and see what's driving the numbers. Like we said earlier, we broke it down in between tax burden, interest burden, EBIT margin, total asset turnover, and the equity multiplier. Ingles' market ROE is increasing over the 5 years, but their ROE is driven by their profitability, but their profitability is being driven by their tax burden and interest. They're, for some reason, being able to keep more taxes, either in a lower tax bracket or based on deductions, and their interest is down. Their interest burden is up, but that means that they're paying less and less interest. So they're not being driven by EBIT margin or total asset turnover, which isn't really a good sign. Natural Grocers ROE increases from years 1 to 3, but decreases from year to 5. The increase from years 1 to 3 was driven by interest burden, while the decrease from years 3 to 5 was driven by a decreasing EBIT margin, which you don't want to decrease. You would rather your EBIT margin increase, so they're not dealing with their operating expenses very well. Sprouts Farmers Market has an ROE increasing over 3 years, then remaining pretty constant, and their ROE is the highest in years 4 to 5. Interest burden and EBIT margin is driving it. Since they don't have much leverage, that's probably why their interest burden is down, and their EBIT margin is up, and their EBIT margin, it means that they're being very efficient with their operating expenses, which is a good quality for a company to have. SuperValue has no ROE information given, so we looked at the things that would be driving their ROE. They have extremely high tax burdens, but if they have not been being profitable, then they've either been getting tax refunds or they haven't been getting taxed at all because they're operating at losses. So their interest burden was high on year 1, but they also have no leverage. They could have finished paying off their debts or whatever they needed to do. Their asset turnover is increasing over years, but like we said earlier, they are selling off their stores, so it makes sense that their asset turnover is increasing because they're probably liquidating their stores, lowering prices, and just trying to get everything out so that they can sell the store and move on. And Weiss Market's ROE remains below average for most years with few fluctuations, and their ROE is driven by their EBIT margins. And looking at the ROE, we would choose Sprouts Farmers Market as the best in the industry as far as ROE goes. Their ROE is driven partly due to increases in EBIT margin, which measure the efficiency and ability of management to keep their operating expenses under control in this competitive industry. Next, we look at market value ratios. Looking at these, Weiss Markets demonstrates the most consistency, although below industry averages. But looking at all of these, all of their market ratios are all over the place, fluctuating high, low, dropping, increasing. They're all over the place. Sprouts has no information for market ratios from years 1 to 2, but in years 3 to 5, their PE ratio, market to book, and enterprise value are the highest in the industry. Even when market value is falling for all these industries, Sprouts Farmers Market remains well above all the other companies. Their EVA is not the highest, but it is steadily increasing from years 1 to 5. According to these ratios, the market is definitely thinking highest of Sprouts Farmers Market. They're a growing company, and although it seems like everybody's market ratios in this industry are going down, they are consistently performing above the rest. Looking at these industry cash flows, they are pretty consistent for most companies. Super value being the outlier, it is the highest for most years. But like we said earlier, they are liquidating their stores, selling off parts of their business. So it's understandable that they have more cash in their business because more people are just coming in and buying things, buying out their stores. Sprouts has increasing free cash flows and has higher cash flows than the others in the industry. Things going on in the industry are affecting these companies similarly, but Sprouts is consistently increasing and handling their cash flows better than the other companies. So this moves us to which company is the best in the supermarket industry, and I would have to say that Sprouts is performing well above the rest, even though they are a fairly new company. They're able to meet all of their short-term obligations. They have debt, but they're not using too much debt. They're able to pay off their debt due to their high times interest earned ratio. They're not the highest in asset efficiency, but their asset efficiency is steadily increasing as their company grows older, eventually becoming almost average in the industry by year 5. They have profits that are driven partially by interest burden, but mostly by their EBIT margin. Their market thinks highly of their future, and they have steadily increasing and above average free cash flows. Next, we are moving on to tobacco and the tobacco products industry. We have Healthier Choices Management Corporation, Schweitzer, Modded International Incorporated, Turning Point Brands Incorporated, Universal Corporation, and Amcon Distributing Co. First, we have the SWM, which is Schweitzer Modded. We're going to call it SWM because that's easier. They manufacture and sell fine papers to the tobacco industry, and they do other stuff in the specialty paper industry, but 90% of its sales comes from the tobacco-related industry products. Turning Point Brands provides tobacco products. They're listed below. Universal Corporation is an independent leaf tobacco merchant. They operate in sectors such as agri-products and the distribution of lumber and building products. They sell, buy, process, pack, store, and ship leaf tobacco to cigarette makers. Healthy Choice Management Corporation, they specialize in producing consumers with healthy alternatives to everyday lifestyles. So they work under the names Healthy Choice Market and the Vape Store, which is why that they are in the tobacco products market, because they own the Vape Store. Next is Amcon. They operate distribution centers and retail food stores offering a variety of consumer products. They are included in this company because they do produce cigarettes and other tobacco products, in addition to a lot of other things that they do. And next, we have their supply chain. Schweitzer Modded has 1 supplier, 6 customers. Turning Point Brands didn't have any supply chain information given. Universal Corp had no suppliers, just customers. Healthier Choices Management only had 1 supplier, and Amcon had 12 suppliers. Next, we look at the short-term solvency ratios. Healthier Choices Management and SWM have decreasing short-term solvency ratios across all 5 years. Amcon remains consistent for all of the short-term ratios, but they have almost no cash in the business. Most of their current assets are in inventory. Turning Point's brands has an increasing current ratio but decreasing quick and cash ratios, meaning they have almost no cash and most of their current assets are in their inventory as well. Universal Corp performs above average for a majority of the past 5 years. They have increasing short-term solvency ratios, and they are one of the most liquid in the industry. Overall, Universal Corp outperforms in current ratio and short-term solvency ratios. Next, looking at the long-term solvency ratios, AmCon, Universal Corp, and SWM are consistent and around average for the industry with their use of leverage. Healthier Choices and Turning Point brands begin to use a lot of leverage from years 4 to 5. Healthier Choices cannot afford their debt. SWM can afford their increase in debt, but as they do increase their debt, their times interest earn ratio is decreasing as they take on more. Turning Point, Universal Corporation, and AmCon can all afford their debt. Universal and AmCon are most able to afford their debt. When looking at the long-term solvency ratios, it's kind of close between Universal and AmCon because their ratios are about the same for both. Next, we look at asset efficiency ratios. SWM, Universal Corp, and Turning Point brands are consistent with their asset efficiency. Healthier Choices is becoming more and more inefficient with their assets as they move through the years. AmCon outperforms all others in the industry with a very high asset turnover, proving they're being the most efficient with their assets. Next, we look at the profitability ratios. Healthier Choices profit margin is all over the place. SWM has a high profit margins, but is declining from years 3 to 5 drastically. Turning Point fluctuates a lot also, sometimes negative, sometimes above averagely positive. Universal Corp is staying consistent. AmCon is extremely low, but consistent. Looking at ROA, basically saying the same thing. Healthier Choices and Turning Point are having huge fluctuations, sometimes going into the negatives. Universal remains consistent for all 5 years. AmCon performs well in the first 4 years, but the ROA significantly drops from years 4 to 5. Based on the profitability ratios, Universal Corp is the best option. They're consistent, although not always above average. They're always remaining around the average. Next, we look further into profitability ratios with the ROE, which, as before, has been broken down into 5 different components. Healthier Choices ROE is driven by a negative EBIT margin, which is, we want it to be driven by EBIT margin, but not negatively. SWM ROE is driven by leverage and their tax burden. Universal Corp is driven by tax burden and asset turnover, but their asset turnover is lowering while their tax burden is also lowering. So their ROE is going down, and it is due to both of these things. AmCon's ROE is driven by their EBIT margin, and Turning Point does a good job of keeping their operating expenses down. As you can see, there's no information given for their ROE for the first 4 years, but we looked at their other ratios, and comparing them to other companies' EBIT margins, they do a really good job at being the highest in the industry, actually, and remaining pretty consistent around there. Next, we go over the market value ratios. SWM is most consistent with PE ratios and the market-to-book ratios. In year 5, Universal and AmCon have the highest market ratios. Market is feeling they both have a bright future based on what is going on in year 5. AmCon is consistent for all of them. Healthier Choices fluctuates a lot. They're pretty inconsistent. Overall, SWM and Universal have the highest market value ratios. All of their EVAs are kind of all over the place, which is due to their industry. It looks like all of them have at some point a negative EVA, and they're all fluctuating severely. But I mean, tobacco and tobacco products has been taking a pretty huge hit in the past couple years with just being cigarettes and tobacco. It's not really in the best of limelight recently. So next we view the cash flows ratio. AmCon is low but consistent. Universal struggles from years 1 to 2, but then significantly increase and continue to increase. SWN is declining over all 5 years. Turning Point is consistent, but then starts to increase, and AmCon just struggles with cash flows. Now to look to see who is the industry winner. Overall, it was very close, but I think Universal Corporation has the best qualities for a company, and I would choose to invest in them over any of the others. They're one of the most liquid companies compared to the other ones. They use debt to their advantage, and they can afford their debt. They're not the highest in asset turnover, but they are consistent and remain consistent. They're consistently being profitable despite big hits in their tax expenses, and their ROE is driven by tax burden. And the overall winner is, if I could only invest in one company, I would invest in Boeing. They have a lot of great qualities as a company. I found that the industry winners for the other two, they lacked in some places, but Boeing is a stable company with a management team that knows how to keep their operating expenses reasonable and create profits. The market likes Boeing and thinks they have a strong future. When others in their market were struggling, they were improving and always turning profits. When looking at the other industries, they just lacked in different places, but Boeing consistently had really good ratios and performed above almost every other company in their industry. And if I only had, money to invest, I would invest in Boeing. And thank you for listening to my Finance 653 project.